42% of Gen Z adults say they are ready to start investing in 2026. That is tens of millions of young people opening brokerage accounts for the first time, and 67% of them already own AI stocks. But here's the problem. 75% of the viral finance content they are learning from is misleading. They are treating dividends like a side hustle. They are trading more frequently than any generation before them. And they're building their entire financial education on 60-second TikTok videos from people who have never managed real money. I am 28. I started investing at 16. I have made every mistake they are about to make. Here's what they are getting right, what they're getting wrong, and the actual playbook. Let me set the scene with real numbers, not vibes. According to Civic Science's 2026 data, 42% of Gen Z adults, that is 18 to 28-year-olds, say they are ready to start investing this year. The Motley Fool ran a survey and found 67% of Gen Z investors already hold AI stocks. That is not a fringe thing. That is 2/3 of an entire generation making the same bet. Robinhood, Webull, Public, these apps made it so easy to start that the barrier disappeared. And honestly, that is incredible. Starting young is the single biggest advantage in all of investing. The math does not care about your salary. It cares about your timeline. If you are 22 and you start putting $100 a month into a broad index fund at a historical 10% average, you retire with over $1 million. If you wait until 32, $380,000. 10 years cost you 2/3 of the result. That is the power of starting early. And Gen Z is starting early. So before I rip into the problems, and there are problems, let me give credit where it is due. Gen Z is getting 3 things right. 1. They're starting young. I just showed you the math. Every year you wait costs you more than you think. The fact that tens of millions of people in their early 20s are opening brokerage accounts is the single most bullish thing about this generation. 2. They have conviction in AI as a secular trend. 67% owning AI stocks is not just hype chasing. AI is restructuring every industry on the planet right now. The problem is not the thesis. The problem is how they are expressing it, and we will get to that. 3. Loud budgeting. This is one of my favorite Gen Z trends. Instead of pretending to be rich, they are publicly cutting spending to free up capital for investing, saying no to the $200 dinner, posting about it, making frugality cool. That is incredible. When I was starting out, saving 80 to 90% of my income, nobody was doing that publicly. Gen Z made it a movement. Okay. Now here's where it goes sideways. A report from DIY Investor, published in June 2026, analyzed the most viral finance content on TikTok and YouTube Shorts. They graded it for accuracy. 75% scored a C or below. Let that land. 3 out of every 4 viral finance videos your generation is learning from are getting it wrong. Not a little wrong. Misleading claims about returns. Cherry-picked time periods. Strategies that sound smart but have never been back-tested. People with 30,000 followers getting stock picks who have never managed more than a Robinhood account. And the algorithm does not care about accuracy. It cares about engagement. The more outrageous the claim, the more people watch. The more people watch, the more the algorithm pushes it. You end up in a feedback loop where the worst financial advice gets the most distribution. This is the thing nobody wants to say out loud. TikTok is not a financial education platform. It is an entertainment platform that happens to have financial content on it. And if you're building your entire investing strategy on 60-second clips, you are building it on a foundation that is 75% sand. But what specifically are they getting wrong? Let me walk through the big ones because I made every single one of these. Mistake 1. They are trading, not investing. Gen Z trades more frequently than any generation at the same age. Day trading, swing trading, options on meme stocks. Buying and selling the same position 3 times in a week. That is not investing. That is gambling with a brokerage app. And I know because I did it. At 17, I bought Neo. It went up over 4,000%, and I thought I was a genius. Spoiler, I was not a genius. I was lucky. And when the luck ran out, I lost everything on leverage and crash gambling. Woke up to a liquidated account on BitMEX because I did not understand my own stop limit. The data is clear on this. The more frequently you trade, the worse your returns. A Dalbar study shows that the average investor underperforms the S&P by 3 to 4% per year, and the primary reason is behavioral. They trade too much, they sell at the bottom, they buy at the top. Investing means you buy something you believe in, you hold it, and you let compounding do the work. Trading means you think you are smarter than the market. You are almost certainly not. Mistake 2. The dividend obsession. FinTok has somehow convinced an entire generation that dividends are a side hustle. You will see videos that say, buy these 5 dividend stocks and get paid $500 a month in passive income. Just sit back and collect checks. Here is what they are not telling you. To generate $500 a month from a 3% dividend yield, you need to have over $200,000 invested. How many 23-year-olds have $200,000 sitting around? And here is the bigger problem. Dividends are not free money. When a company pays a $1 dividend, the stock price drops by about $1. It is not magic. It is your own money being given back to you, and then you owe taxes on it. Total return is what matters. A stock that grows 20% and pays no dividend beats a stock that grows 5% and pays 3% every single time. The obsession with monthly income from dividends at age 22 is solving the wrong problem. At 22, your problem is not income from investments. Your problem is growth. You need your money to compound as aggressively as possible for as long as possible. Dividend investing is a strategy for people in retirement, not people who just opened their first brokerage account. Mistake 3. They trust without verifying. This one hurts because I see it every day. Someone with a ring light and a confident voice says, this stock is about to explode, and thousands of people just buy it. No research, no understanding of what the company does, no idea what the valuation is. They would not take medical advice from a random person on TikTok. They would not take legal advice. But for some reason, financial advice from a 21-year-old with a rented Lamborghini in the background? Sure, sounds legit. The bar for calling yourself a financial educator on social media is 0. No license, no track record, no accountability. When the stock they recommended drops 50%, they just delete the video and move on to the next one. Here is a simple filter I wish someone gave me when I was starting out. Before you act on any financial content, ask 3 questions. 1. Does this person show their actual portfolio and actual returns, not screenshots, actual verified track records? 2. Are they explaining the risks as clearly as the potential gains? 3. Would they bet their own money on this, and can they prove they did? If the answer to any of those is no, move on. Mistake 4. Meme stocks and momentum chasing. Look, I understand the appeal. GameStop, AMC, the whole 2021 moment, it felt like a revolution. Retail investors taking on hedge funds. Power to the people. But here is what happened after the headlines faded. Most of the people who bought at the top lost money. The hedge funds adapted. And the lesson the market taught was the same one it always teaches. Momentum is not a strategy. It is a feeling. And the feeling is designed to make you buy at the exact wrong time. By the time a stock is trending on social media, by the time your friend texts you about it, by the time it shows up on your For You page, the smart money has already positioned. You are not early. You are the exit liquidity. I learned this the hard way with crypto in 2018. By the time I was telling my friends about Neo, the people who actually made money were already selling to me. The pattern repeats in every cycle, in every asset class with every generation. The only people who consistently make money from momentum are the ones who got in before it trended. Everyone else is paying their tuition. Now, here's the part where I have to be honest with you. I am not standing here as someone who avoided all of these mistakes. I am these mistakes. I bought crypto at 16 and thought I was a genius. I gambled on leverage and woke up liquidated. I chased momentum, trusted people who had no business giving advice, and spent years thinking I could outsmart the market with the perfect trade. The total cost of my financial education through mistakes was probably over $50,000 in losses and missed gains before I turned 22. And the only reason I am standing here with a real portfolio today is because eventually, I stopped doing all of those things. I stopped trading and started investing. I stopped chasing dividends and focused on total return. I stopped trusting FinTok and started reading actual research. I stopped looking for the perfect entry and started letting time do the work. Saved 80 to 90% of my income. Bought quality companies and broad index funds. Traded options only as the sharp edge, not the whole portfolio. Crossed $1 million in 2025. Not because I am smart, because I finally got boring. And boring is the strategy that actually works. So here is the playbook. This is what I would do if I were starting over at 22 with everything I know now. Step 1. Open a brokerage account with a real platform. Fidelity, Schwab, Vanguard, even Robinhood is fine to start. The platform does not matter nearly as much as starting. Step 2. Before you buy a single stock, put 70 to 80% of your investable money into one broad index fund. The S&P 500. Total market. Pick one. Set it to auto-invest weekly or monthly. And then do not touch it. This is the foundation. This is the thing that compounds while you sleep, while you make mistakes with the other 20 to 30%, while you learn. The market has averaged roughly 10% per year for 100 years. Through wars, recessions, pandemics, everything. You do not need to beat it. You need to be in it and let time do the work. Step 3. Take the remaining 20 to 30% and call it your learning budget. This is the money you use to learn. Individual stocks, maybe an ETF focused on a thesis you believe in, even options if you are going to educate yourself properly first. This money will teach you more than any course, any book, any TikTok video. Because when your own money is on the line, you pay attention. You will learn what it feels like to hold through a 20% drawdown. You will learn why you sold too early. You will learn that the stock you were so confident in does not always go up. The key is this: if you lose this entire 20 to 30%, your portfolio barely flinches. Because the 70 to 80% in the index fund is doing the heavy lifting. This is how you learn without blowing up. This is the structure that lets you make mistakes without resetting the clock. Because here is the thing nobody on FinTok will tell you. You cannot compound from zero. If you blow up your whole account chasing one trade, the years you already put in are gone. Step 4. Build the habits that compound. Auto-invest so you never have to decide whether to invest this month. Check your portfolio no more than once a week. Seriously. The more you look, the more you trade. The more you trade, the worse you do. Step 5. Spend 1 hour a week reading actual financial education, not TikTok, not Reddit threads, actual books. The Psychology of Money by Morgan Housel. The Intelligent Investor by Benjamin Graham. A Random Walk Down Wall Street. These books have more signal in 50 pages than 1,000 FinTok videos. Step 6. Find 1 or 2 people who are further ahead than you and actually have results. Not followers, not engagement, results. A real portfolio, a real track record, a real willingness to show you the losses alongside the wins. That is the playbook. An index fund as the foundation. A small learning budget for skin in the game. Habits that remove emotion from the process. Education from sources that have earned your trust. It is not sexy. It is not a 60-second clip. But it is the strategy that actually builds wealth. Here's the thing I want you to walk away with. Gen Z is not stupid. This generation is the first in history to start investing in their early 20s at scale. That is extraordinary. That is a genuine competitive advantage over every generation that came before. The problem is not the instinct. The instinct is right. The problem is the information. And when 75% of what you are learning from is wrong, even the right instinct leads you to the wrong place. So be skeptical. Verify everything. Build the boring foundation first. Let time do what time does. And stop taking financial advice from people who cannot show you their receipts. I am 28. I have been doing this for 12 years. I have lost more money on stupid mistakes than most people my age have invested. And the only reason I am here is because I eventually learned that the boring path, the patient path, the path nobody makes viral content about, is the path that works. You are not behind. You are early. Do not waste it. I am building a community of people who think like this. Long-term patient, hunting asymmetric bets, the small risks with the big upside. It is free right now. Follow Wealthy Beaver on X. The handle is on screen. And if you know someone in their 20s who is just starting to invest, send them this video. It might save them $50,000 in tuition. It saved me.